Thanks for clicking. Stats Canada released Canada's economic data for the first quarter this morning, showing an economy that beat expectations, with Canada's GDP growing at 3.1%, much higher than the 2.5% that had been anticipated. Indeed, the hotter-than-expected GDP data, combined with surging inflation data that we got a few weeks ago, will put even more pressure on the Bank of Canada to raise interest rates at its next meeting. And a close look at the data shows that there's more than just a headline growth rate, which will have the Bank of Canada concerned, as we're seeing signs of a resilient economy, with households continuing to spend and workers continuing to earn more. So what I want to do today is go over the release of Canada's GDP numbers for the first quarter, take a look at those areas that will have the Bank of Canada Governor Tiff Macklem the most concerned, and then discuss what to look for next. Speaking of next, we do have a big week coming up with May's real estate data set to be released by the local boards, as well as the Bank of Canada's rate announcement coming out next Wednesday. We'll obviously have updates out on both on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this report. Onto the report. As mentioned, Canada's GDP data came in much hotter than expected at 3.1% for the first quarter of 2023, with previous expectations sitting at 2.5%. And while the economy performing better than expected will no doubt have the Bank of Canada concerned, the household spending data will have it especially worried as it tries to get our inflation rate back down to 2%. Despite 425 basis points in rate hikes, Stats Canada show that Canadians are continuing to spend, as spending on goods and on services continues to rise. This is going to come as particularly bad news to Bank of Canada Governor Tiff Macklem, who only a few weeks ago touted the reduced spending on behalf of Canadians.
Demand for goods is slowing because higher interest rates are restraining household spending.
But looking at the data, spending on motor vehicles was up 7.8%, spending on travel was up 6.8%, spending on garments was up 4.5%, and spending on food was up 4.4%.
Like Rose Kennedy, with all our money.
But it's not just goods and services that showed acceleration. Wages also continued to creep upwards in the first quarter of this year. Wages were up 1.7%, which actually accelerated from the previous print of 1.2% and was the fastest acceleration in wage growth since the second quarter of 2022, right before the CPI hit 8.1%. And this is going to be of particular concern to the Bank of Canada, as it has been adamant in the past that employers not raise wages, as doing so would only fuel inflation.
Most wage growth measures remain around the 4 to 5% range. Unless productivity growth surprises us with a strong increase, persistent wage growth in that range will make it difficult to achieve the 2% inflation target.
As a side note, Deputy Bank of Canada Governor Carolyn Rogers actually said at their previous press conference that Canadians could look to their higher wage growth in order to help them with higher mortgage payments.
The other thing to keep in mind is there will be mitigating factors. So normally, if you're renewing a mortgage that you took out 5 years ago and you see a jump in payment, it's very likely you will have had some increase in income that will offset that payment. So you have room, if the payment increase that you see creates stress in your household budget, you do have a number of ways to mitigate that stress. So it's very hard to generalize.
Regardless, looking at the data today, we have an increase in consumer spending, which the Bank of Canada really doesn't want to see, and we have an increase in wage growth, which the Bank of Canada really does not want to see. And with Canadians continuing to spend and the economy proving much more resilient than many had anticipated, some are predicting that this new economic data will put more pressure on the Bank of Canada to raise rates even higher. And that's definitely a possibility. Preliminary data showed that the economy grew in April at a rate of 0.2%, which was up from the 0.1% that had been anticipated. Given the continual surprises, that inflation surprised to the upside, that the economy surprised to the upside, I think the Bank of Canada has seen this show before. My guess is that the bank is going to want to get ahead of this. I think the bank lost a lot of credibility when it insisted inflation was transitory, and we all know how that turned out. And I think the bank isn't going to want to see that happen again. I think we could see the bank go another 25 basis points at its next meeting, If not the next one, then the one after that in July. And then I think we'll see how inflation and the economy performs from there.
I hope this sucks.
While I don't have a crystal ball, I don't think the Bank of Canada is going to risk seeing inflation reignite, and I think that they understand full well that if they were to implement one more rate hike at least, that would send the message to Canadians that perhaps the Bank of Canada isn't on pause as much as has been widely accepted. With that said, whether or not the Bank of Canada will raise rates does remain to be seen, and we'll obviously have an update out on that rate announcement on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.